Greetings, members one and all of the Salivation Nation. It looks like the Federal Reserve is quite comfortable with higher inflation. Let's explore. For most of us out there, that's a little bit troubling. You know, we haven't had a raise in our paychecks for quite some time. In fact, if you get less than 2% of a cost of living increase, essentially your salary is getting cut each year because the dollar by design loses that much value each year from the policies from the Federal Reserve. Well, things are changing. They're printing more money. In fact, even your stimulus checks, your so-called relief checks that you got, that $1,200, that cost you on average about $16,000 to receive that check. Not a good deal for the American public for sure. A little quick injection of liquidity, maybe into paying off some bills, but essentially it is a driver of debt. You're buying time for the Federal Reserve and the government to just increase that debt. But this comes to us from Reuters. Fed policymakers signal comfort with higher inflation. In the week since the Federal Reserve made a landmark shift in its approach to monetary policy, you heard me cover that previously, details are emerging of what it could look like in practice, with two Fed policymakers on Thursday saying they'd be comfortable with leaving interest rates near zero, even if inflation rises to levels not seen on a sustained basis in some 30 years. Here we can see Jerome. We have Chicago Federal Reserve Bank President Charles Evans here. Remarks from a number of Fed policymakers in recent days suggest that a shift to a more accommodative stance in pursuit of higher inflation isn't imminent, and that most feel the next move to support the economy needs to come from Congress. Partisan politics threatens to endanger additional fiscal relief, the president of the Chicago Fed, Charles Evans, told the Lakeshore Chamber of Commerce in Hammond, Indiana, in one of the sharpest rebukes yet from a Fed policymaker to lawmakers who have been at loggerheads for months over the size of a new relief package. A lack of action or an inadequate one presents a very significant downside risk to the economy today. This comes after new job reports bring us back to basically recovering half of the jobs that were lost since the pandemic began in the news reports today. But nonetheless, there are still some states that are essentially shut down, big states, economic drivers. You know, the restaurant industry is suffering horribly. Many service industries are at this point. Once the coronavirus is under better control and unemployment has come down somewhat, he said, the Fed may need to shift its accommodative policies into higher gear. That push, he said Thursday, could take the form of promising to keep interest rates pinned near zero until inflation reaches 2.5%, well above current low levels and modestly above the U.S. Central Bank's inflation target of 2%. So he'd be comfortable with inflation going up 2.5% as long as we are trying to average off very low inflation rates, Evans told reporters on a call. The U.S. Central Bank announced last week that it was revising its approach for setting monetary policy to focus more on addressing shortfalls in employment and less on inflation. You know, I think it's good to get people back to work for sure, but you know, their paychecks are going to be suffering. More than likely, these jobs returning, they're going to be making the less or the same or maybe even less to accommodate losses in revenue for these businesses. And keep in mind, this inflation target of 2.5% now, well, you have to keep in mind that by other measures, the dollar has lost 10% of its value in the last 3 months or so, 4 or 5 months, really, about 5 months. It's lost that much. And really, since 2016, we've seen an even greater loss by other measures, maybe as high as up to 15 to 20% by some measures. Few, but some at least. The U.S. Central Bank, with focusing on addressing shortfalls in employment, because we got to get that tax revenue coming back in. But at the same time, it's almost a moot point because the Federal Reserve, before all of this even started, has been injecting liquidity into these repurchase agreements between central banks. They've really done a number behind the scenes. They do a lot, so much that we're not aware of, that is hurting the dollar. And they really are coming to a point of hubris in terms of thinking that the dollar will be able to survive all this. It is the best of the worst out there, but that ain't saying much. The article continues. Evans was the architect of an approach the Fed adopted in 2012, in which it vowed not to raise rates until employment fell below 6.5%, as long as inflation was projected to rise to no more than 2.5%. I think the way we did it in 2012 is not unattractive, but our environment is somewhat different now because we are saying we want to average 2%, Evans said. In a similar vein, Atlanta Fed President Raphael Bostic said he would not be concerned with inflation going to about 2.4%. Well, he's a little conservative with a tenth of a percentage point off in the 2.5. You got to give him that. I say that sarcastically if you can't recognize the tone of my voice. As long as we see the trajectory moving in ways that suggest that we are not spiraling too far away from our target, I'm comfortable just letting the economy run and letting it play out, Bostic said in an interview with Wall Street Journal on Thursday. Well, that's nice. I tell you what, that little platitude to libertarianism is a welcome statement, but I'm not buying it, really. While the Fed's preferred gauge of inflation, the core PCE index, measured above 2.4% a few times in 2006 and 2007, the last time it did so for a sustained period was in the early 1990s. Fed policymakers are in complete agreement that the Fed should not raise rates preemptively as unemployment falls, unless you see inflation, Bostic said. And the other thing, too, is there's been some talk that the Federal Reserve is finding a new way to measure inflation. Right now, between each of the central banks, 12 districts, they do their own kind of measures by measuring the CPI, Consumer Price Index of common goods. They're going to tweak those numbers and find new ways to measure them. Well, that 2.5% by the new measure may really be 3% by the old measure. So we'll see how they do it. And that's just it. With data, you can really make it say what you want it to. And make no mistake, through all of this, what do you and I agree on? That's the answer. They cannot tweak the numbers on this gold, fine gold, that's right, which is the ultimate store of wealth. And this is why, even with the prices where they're at now, I am in a buying mode. I'm just buying less because the dollar will survive in some manner or form. What that will play out to be, I'm not sure. But we know by its very design, the dollar is designed to depreciate each year by at least 2%, and now they're comfortable with 2.5 or 2.4%. But gold will survive, and it has survived beyond epochs, beyond empires, beyond republics, beyond any kind of systematic government out there, whether it be world, regional, local, or what have you. Gold has stood the test of time. What does that mean for me? That means I'm going to be buying more of it when I can afford to do so. But I'm going to try to be smart about it as well. But I believe that the gold I do have is going to protect me in the case of a depreciating dollar, even when the price falls. That's right. And why is that? Because I look through the lens of a telescope, not through the lens of a microscope. You have to look down into the future and look where things are going. And sometimes looking into that future lens requires you to take a look at history, because history is the gauge of the future. And what has gold done throughout history? It has preserved its value. And that's why I believe that gold, being the ultimate hedge, is something that I would advise, even though I'm not a financial advisor. It's prudent, I believe, to put at least some of your wealth into gold to back against economic instability out there and against the comfortability of inflation drivers that policymakers make, whether it be in Washington, D.C. or Jackson Hole, Wyoming. So therefore, I will continue to press on with gold in one form or another, and silver too, but especially gold. And I would encourage you, silver stackers out there, if you're a hardcore silver stacker, to pause and take a look at gold as a way to even more stabilize your holdings with an asset class that is the ultimate hedge against economic instability. Be your own central bank. Gold. I would like to extend a multitude of gratitude to you all for taking the time to watch this video, and encourage you to please rate, share, comment, and subscribe.